Right now, as we speak, Navitas Semiconductor, trading under the ticker NVTS, is exchanging hands at exactly $8.25. The stock is seeing a slight downward pressure today, currently sitting down about 0.78% for the intraday session. When you look at that red number on your screen, the immediate expectation is that this is just another struggling small-cap semiconductor play getting battered by the usual headwinds: high interest rates, sector rotation, or perhaps a missed earnings whisper. The expectation from the retail crowd is often one of immediate concern. They see the price slipping, they see the negative headlines about revenue drops, and they assume the growth story is broken, or at least paused indefinitely. But here is the reality that most people gloss over while staring at the red tick on their charts. What you are witnessing isn't a failure of the business model, but rather a deliberate surgical amputation of a dying revenue stream to make room for a massive, high-stakes transplant into the heart of the AI power revolution. The market is pricing this like a company that lost its customers. The reality is that Navitas is actively firing its low-margin customers to prepare for a heavyweight fight in the data center arena. This isn't a stumble, it is a calculated retreat before a potential blitzkrieg, and that creates a very specific type of opportunity and risk that we need to unpack piece by piece. Let's talk about what is actually happening on the charts and in the order books today. That $8.25 price point is acting as a very fragile battleground. We are seeing volume today that suggests a tug-of-war between frustrated retail investors who are tired of the volatility and institutional accumulators who are quietly stepping in. The recent 5% drop we saw earlier in the week, triggered largely by insider selling headlines and that brutal earnings reaction, has left a lot of weak hands shaking. When you log into your brokerage account, whether you are using a sleek mobile interface like the Robinhood app or a more robust desktop setup like the Interactive Brokers trading platform, you are likely seeing a lot of bearish sentiment in the news feeds. The chatter is all about the revenue miss, and it was a big one. But if you look closer at the order flow, you notice that the selling pressure is beginning to exhibit signs of exhaustion. The volume spikes we saw during the initial drop are tapering off, which often signals that the panic selling phase is nearing its end, leaving behind only the committed long-term holders and the opportunistic buyers. The context for this movement is critical. The broader semiconductor sector has been a mixed bag recently. You have the titans like NVIDIA stock absolutely crushing it, setting the tempo for the entire industry, while smaller players like Navitas are often left in the wake, struggling to prove they belong in the same conversation. But this is where the expectation versus reality dynamic gets really interesting. The expectation is that Navitas is just a charger company, the guys who make those little chips for your fast-charging phone bricks. And to be fair, for a long time, that was true. That was their bread and butter. So when they announced recently that they're guiding for significantly lower revenue, dropping to around $7 million for the next quarter, investors freaked out. It looks like a collapse. But the reality is that they are intentionally walking away from the low-margin China mobile market. They are effectively saying, we don't want this business anymore because it doesn't make us enough money. Instead, they're pivoting hard toward high-voltage, high-power applications for AI data centers and electric vehicles. This is a classic J-curve moment, where financials look terrible just before the new strategy take hold, but the market, being short-sighted, only sees the drop. We need to discuss the recent capital raise because it is the elephant in the room. Navitas recently secured $100 million in a private placement. Now, if you are a shareholder, your immediate reaction to a capital raise is usually a groan. You think about dilution. You think about your slice of the pie getting smaller. That is the expectation. Dilution is bad. But let's look at the reality of why they raised that money. They didn't raise it just to keep the lights on. They raised it to fund a massive expansion into the US manufacturing space through a new partnership with GlobalFoundries. This is a strategic war chest. In a high-interest rate environment, having $150 million plus $100 million in fresh capital puts them in a position of strength compared to competitors who might be starving for cash. It allows them to survive this transition period where revenue is thin. If you are managing your own money, perhaps using Schwab Intelligent Portfolios or doing some self-investing through Fidelity Wealth Management, you know that cash is king during a turnaround. Navitas has secured its runway, which de-risks the bankruptcy thesis significantly, even if it hurts the stock price in the short term. Now, let's get into the meat of the business, because you need to understand what you are actually buying at $8.25. Navitas creates gallium nitride and silicon carbide power integrated circuits. If you're not an electrical engineer, that sounds like a mouthful of jargon. Here's the simple version. Traditional silicon chips, the kind we've used for 50 years, are hitting a physical limit. They can't handle high voltages and fast switching speeds without getting incredibly hot and inefficient. GaN and SiC are advanced materials that allow chips to handle way more power, switch way faster, and stay way cooler, all while being physically smaller. This is absolutely critical for two things: charging your Tesla stock, your electric vehicle, faster, and powering the massive energy-hungry data centers that run AI models. The AI angle is the real hook here. Everyone is talking about the processors, the GPUs from NVIDIA or AMD, but nobody talks about the power. These AI racks consume an ungodly amount of electricity. If you use traditional silicon-powered chips, you waste a huge percentage of that electricity as heat. You need massive cooling systems, which take up space and cost money. Navitas's GaN chips can improve efficiency so much that data centers can actually pack more processors into the same rack space because they don't need as much cooling equipment. This is the reality that makes the stock interesting. The expectation is mobile phone chip maker. The reality is critical infrastructure provider for the AI boom. They recently announced support for 800-volt power architectures, which is exactly where the industry is heading for next-gen computing platforms. This transition, however, is painful. We saw that in the Q3 earnings report. Revenue came in at $10.1 million, which was a miss, and it was down significantly from the previous year. That's a hard pill to swallow. They reported a loss per share of $0.05. When you see numbers like that, it's easy to see why the stock is down today. It's easy to see why analysts at firms like Morgan Stanley or Jefferies might have mixed ratings. But you have to look at the why. The drop in revenue is almost entirely due to that strategic decision to stop selling to the low-end mobile market in China. They're sacrificing sales today for better margins tomorrow. It's a gamble, pure and simple. They're betting that the high power demand from EV and AI sectors will ramp up fast enough to fill the hole left by the mobile business. If they're right, the stock at $8.25 is a steal. If they're wrong, or if the AI adoption slows down, they could be in trouble. Let's take a moment to engage with this idea. Comment below how many shares of Navitas you currently hold, or if you are waiting for a lower entry point. And while you're at it, I want to hear your take on the broader chip war. Do you think the government will pass more legislation in favor of domestic manufacturing that could benefit companies like Navitas? The partnership with GlobalFoundries to manufacture GaN chips in Vermont is a direct play on this Made in America trend, and it's something that could protect them from geopolitical tariffs, which is a huge advantage over competitors relying solely on Asian supply chains. Moving back to the analysis, we have to talk about the institutional activity. Despite the scary headlines, big players are not abandoning ship. We see substantial ownership from giants like Vanguard and BlackRock. When you see these names on the registry, it tells you something. These firms don't just gamble on penny stocks, they do deep due diligence. Their continued presence suggests that they see the long-term value proposition of gallium nitride replacing silicon. It's similar to how people used to view online investing or investing sites a decade ago. Skeptical at first, but now it's the standard. GaN is on that same trajectory. It's currently a niche, high-performance option, but eventually it will likely be the standard for all power electronics. If you are using a Robinhood app or SoFi Invest to track this, you might notice the hold ratings dominating. That's code for "we see the potential, but show us the execution." The partnership with GlobalFoundries is probably the most significant news item that isn't getting enough airtime. By moving production to a major US foundry, Navitas is securing its supply chain. During the last chip shortage, companies died because they couldn't get wafers. Navitas is insulating itself from that risk. Furthermore, GlobalFoundries has the scale to drive costs down. One of the biggest knocks on GaN technology is that it's more expensive than silicon. If Navitas and GlobalFoundries can close that price gap, there is no reason for any engineer to